Hi, this is Todd Phillips. Welcome to Smarter About Taxes. I'm sitting here on a beautiful Sunday morning and I thought I would waste it teaching you all how to calculate capital gains taxes. So kind of a fun subject, kind of complicated for some people, sort of a brain teaser, I think. So I want to walk through it step by step. So if you're confused about calculating it, this is really based on investment real estate. So that's what we're going to go over. And I've got a few examples in here. Follow along. I would highly recommend grab a pencil and a piece of paper and kind of do the math alongside me. That's going to really help it sink in. And there's a couple concepts in here. Maybe you get it right away. Maybe you want to look at it a couple times. There's no shame in it. Even accounting students struggle with this their first time they take a tax course. So don't feel bad if you don't get it on the first uptake, but some of you may get it right away. We're just going to walk through it, and I'm going to help you learn it. I'm trying out a new screen recorder today, so give me have some patience if I can't get from one screen to the next, but we're going to work through it best we can. All right, here we go. First lesson, probably the biggest lesson or only lesson today. If you know how to do math, then this first lesson is the most important. It's vital to distinguish that how much cash you get from the sale has nothing to do with how much taxable gain you have on the sale. So get that out of your head right now. Distinguish those two things. Uncouple them in your brain. The cash you get has just no bearing at all on what your taxable gain does. Okay? Why is this so hard? I don't know. But if you remember this problem, you've seen it on the internets. Joe borrowed $50 and bought a cow for $80. Put in 30 of his own money, borrowed $50. Sold it for 100. Then he bought it back for 110 and sold it for 120 and paid back the $50. How much money did he make? So people that are like me that are used to doing these calculations, we know right away, $30. A lot of people struggle with this though, and if you look on the internet, how many people come up with weird and crazy different ways to do this? I don't know, but calculating gain on sale is a lot like this problem. So we're going to walk through it step by step. So just remember, how much cash Joe got has no bearing at all on what Joe's gain is. Okay, so here's our formula. Really, really simple. The sale price of what you sell minus your tax basis equals gain. Pretty simple, right? Calculating the tax basis is the hard part, okay? So in this case, we're just going to simple example. We bought a building for $1 million. We took depreciation against that building over time, right? We owned the property for a while. We were allowed to take a bit of depreciation as it goes along. Our tax basis has been reduced to $400,000. It's $1 million the day you buy it. In this case, we depreciated it. Now our tax basis is $400,000. Here's another way to look at it. If you think of it as changes over time, okay? Your basis changes over time. It's not just what you paid for the building. So on the far side of your screen, at the start of the arrow, that's the date of purchase. In our case, our basis was $1 million. Then we have changes to the basis. And then at the very end, what's our basis on the date of sale? Changes over time. So what are the things that change? That make your basis change? The three main ones you're going to see. Your basis goes up when you make improvements to the property. So you put a air conditioner unit on the roof. That's going to add to your basis. You reduce your basis for depreciation. So that HVAC unit will depreciate, plus the building will depreciate, plus the parking lot, all the other improvements. Land is not depreciable, so that's not going to move. And then if you demolish or remove any improvements, so if you had an air conditioner on the top and you removed it and you put on a new one, the cost of that, whatever basis you had in the old one, you can write off. So you're only going to get those changes to basis if you report them on your taxes, okay? Long story, I'm not going to get into allowed or allowable. That's not part of this. Here's a depreciation schedule. This is where you can find your basis. So if you have a good CPA or tax preparer, you should be able to look in your tax documents, find out what your basis is. I'm not going to go into too much detail, but this is sort of what it looks like. You can see that there's unadjusted cost or basis. That's before all the adjustments in time. Accumulated depreciation, current year deduction, those things are the taking of depreciation. So you want to go ahead and find what your basis is on the date of sale. Okay, again, this was our example. Our basis is now $400,000. So we sell the property for $1.7 million. We bought it for $1 million, sold it for $1.7. Good deal. Hey, our basis at the time we sold it, $400,000. Our taxable gain is $1.3 million. Okay, so here's now. I want to again distinguish from the cash you received. You sold it for $1.7 million. I don't care how much cash you receive. Your gain is $1.3 million. Let's just look at how the cash flow works. So I purchased the property. We purchased it for $1 million. We used $200,000 of cash, and we borrowed $800,000. Now, over time, we pay that down, and you can see our debt at the sale date is $500,000. So it's gone down from $800 to $500. Again, that has nothing to do with the taxes. We just paid it down. So our cash proceeds from the sale, in this example, were $1.7 million. We repaid our debt, because you have to when you sell the property. The lender's going to require that. Okay, of $500,000. We netted cash of $1.2 million. So our taxable gain, $1.3 million, net cash, $1.2 million, not the same thing, not correlated at all. Okay, we're going to do another example here, just to show how this can be really different, right? So again, same property, we bought it for $1 million. We put in $200,000 of cash, borrowed $800,000, but we refinanced. After we refinanced, and when on the date of sale of the property, we owe $1.1 million. Okay, so if we compare example 1 and example 2, we're going to have different cash amounts that we receive on the date of sale. So in example 2, we sell the property for $1.7 million. We repay that $1.1 million, and now we only have $600,000 of cash. That's the blue number you see there. So in the two examples, 1 and 2, different amounts of cash received on the sale date, but you'll see our taxable gain exactly the same, right? So they are not related. I want to drive that point home, that they're not related. So now let's calculate sort of what the tax will look like on this example sale. So we go back, we said, yep, our taxable gain's $1.3 million. Everybody gets that now. Let's calculate our state income taxes. Now, this is my home state of Minnesota. For those of you that don't live in Minnesota are going to gasp at how high our tax rates are, but we don't have capital gains tax. Everything is taxed at your tax bracket. So in this case, the highest tax bracket is 9.85%. So we sell our property, we've got taxable gain of $1.3 million. We owe the state, in this case Minnesota, $128,050. Okay, I did state first. A lot of people do federal first, but state's just kind of easy to calculate. So I did that one, get it out of the way. Federal, we have this idea of recapture and capital gains. They're different tax rates, and they tax a different piece of the gain. So we said we have taxable gain of $1.3 million. It's been carried throughout the problem. Okay, but we took depreciation of $600,000. Okay, federal IRS rules, the federal tax code tells you you have to pay a different tax rate on recapturing that depreciation. In this case, this is real property. We're recapturing that at one rate, and we have capital gains at a different rate. I'm going to show you that calculation. So if you see, sorry, going back here, if you see the recapture and the capital gain add up to the $1.3 million. Okay, so everything that's recapture comes off your taxable gain, and then the rest is a capital gains rate. So if you take your $1.3 million, subtract that $600,000 recapture, that's how we get the $700,000. The remaining amount is capital gains. Okay, here's the calculation. Our recapture of $600,000 times 25% rate is $150. Our capital gains of $700,000 times a 20% rate is $140,000. We add those together, and our subtotal for federal tax, $290,000. Okay, so I always tell people, you know, they say recapture is bad. Well, if you were in the 37% tax bracket when you took that depreciation, and you're now in the 20, and recapture's taxed at 25%. Okay, that's a 12% delta. So if I said, hey, the IRS will give you a loan of $100,000, and they don't require that you pay any interest on it over the time frame. And when you do pay it back, you may be able to pay it back for as little as 65 cents on the dollar. You'd probably take that deal, right? So think of recapture as repaying a loan the government gave you interest-free. Okay, not necessarily free money, but if you don't have to pay it back at 100 cents on the dollar, there is a portion of free money there. So always, you know, depreciation is a good thing for investors, right? don't look at recapture as bad. Just plan for it if you're going to not do a 1031. Okay, I'm rambling. Subtotal $290,000. Don't forget about the net investment income tax, the Obamacare tax, some people call it, another 3.8% tacked on there. I don't know. It's supposed to reduce health insurance costs. Mine didn't go down, but I won't get into politics. That 3.8% is going to ding you another $49,400. Okay, total all that up. State income tax 128, federal capital gains, federal recapture, net investment income tax, for total taxes of $467,450 in this example. The reason we're going through this, I'm going to show you two examples. One is get back to that refinance and show you what our net tax is. Okay, so back to example 1, $1,700,000 sale price. We got to repay that debt on closing. We already talked about that. Net cash on sales $1,200,000. Then we go to file our tax returns. We owe another $467,450. Our take-home cash from this transaction $732,550. Okay, we go to example 2 where we had that refinance in there. Okay, it's going to reduce our take-home cash. Makes common sense, but let's just walk through the numbers. Our cash proceeds is $1.7 million. Our debt now higher, $1.1 million. Our net cash received $600,000. We go to tax day, file our tax return. We owe $467,450, and our take-home cash is only $132,550. So our take-home cash drops significantly. This is why you see people do 1031 exchanges, right? You're not getting much cash out of this sale. You did get cash when you refinanced it and increased your debt amount, but at sale time you're not getting much. So maybe it makes sense to do a 1031 exchange. Okay, I'm going to go through 3 problems real quickly here. These are, if you want to slow this down and pause it and kind of do the math, this is where I think it's going to make sense to you. But I go through these problems for a particular reason. Okay, problem 1, super simple deal. We purchased something for $200,000. We take $150,000 of the basis over at single family home. Our basis at the date of sale is $50,000. When we bought it, we had $100,000 of equity and $100,000 in debt. And so we, 50% leverage. Now we go down to the sale. We sell the thing for $300,000. It's gone up in value. We still owed $100,000 on the date of sale, and our equity in the date of sale is $200,000. Again, stick to this problem 1 column. Our gain on sale is $250,000. That has nothing to do with how much cash we got, right? That's our sale price of the $300,000 minus the basis. I'm going to go back to that slide. Sale price of $300,000. That's about 5 lines, 6 lines down, minus our basis, which is 3 lines down. That's that gain on sale of $250,000. Okay, calculating the tax. State tax $24,000, recapture tax $37,000, capital gains tax $20,000, net investment tax $9,500, total tax of $67,000. Okay, moving on to the last page here of problem 1. You received on the date of sale $300,000 in cash in the transaction, right? The closing agent got that wire from the buyer. They paid off your debt probably right at closing, so that $300,000 came into the closing agent's account. They paid $100,000 to your lender, and now you're going to net $200,000. You go to pay your taxes on April 15th. The taxes paid $67,000. You get net cash $133,000. Nice deal. So that's walking through that. I'm going to do problem 2 though, where we've done a refinance. Again, like a higher debt amount than we originally borrowed. So we purchased our building in this case for $2.5 million. We took depreciation, we owned it for a long time at $1.75. Our basis is all the way down to $750,000. When we started, we had equity of $1 million and debt of $1.5. But at the sale, in this case, we have debt of $2.6. We did a nice, healthy refinance. We owned it for a long time. And our sale price $3.2 million. So you'll notice sale price is higher than purchase price. So we've made money. Okay, we're selling it for more than we bought it for. But our debt is $2.6 million. So the cash you get again has nothing to do with how much your taxes are going to be. So in this case, gain on sale 2.45. I'll let you go back if you want to flip back to that other slide and do that calculation again. But our gain on sale is the sale price less our basis. Our state tax, our recapture cash, our capital gains tax, and our net investment income tax, all of that adds up to $670,600. Here's where this thing gets kind of wonky and people get sideways. Your cash received was $3.2 million on the closing statement. The agent took that in, closing agent. Then they repaid your debt of 2.6, and now you have 600 grand. Okay, but you go to pay your taxes, and you find out your tax bill $670,600. That's because you did that refinance. Okay, so technically you're out 70 grand from doing the sale, but you've already received some of that cash. Okay. But can you be upside down on a sale? Absolutely. I see this once a week in my practice, that people are upside down and they're going to actually owe money out of pocket to sell a property. Absolutely a case for a 1031 exchange, right? We want to make sure that we continue to let that money work for us rather than just take all the money and give it to the government. Okay, problem 3. This one is a little different. This is an example of a foreclosure. So if your property is foreclosed on, all your equity is wiped out. You don't have any cash. You're not going to get any cash at the sale. It's all going to go to pay off your debt. I said sale. I jumped the gun here. But that foreclosure is treated as a sale for tax purposes. So in this case, we had a property we bought. Say it's a small duplex, bought it a while ago, $300,000. We took depreciation of $200,000. We owned it a while. Okay, our basis was 100 grand. We had initially had equity of 50 and borrowed 250. Okay, our sale price in this case, we still have debt of 250. We're just going to go with that for our fact pattern. We have debt of 250. We must have refinanced along the way. That's considered to be our sale price in a foreclosure. So the bank comes and takes it back from us. We're considered to have received $250,000 in cash. Okay, so here's the problem: we have a gain on sale because our basis is only 100, and our gain was that gave us a gain of 150 because we had a deemed sale price of 250. So calculate state taxes, calculate recapture tax because all of that was due to depreciation, and potentially paying the net investment income tax here. It's a deemed sale. Our total tax, $43,200. We go to the same page here where we were collecting our cash. We are deemed to have received cash of $250, but it all went to the lender, so we have no net cash, but we have a tax bill of $43,200. This is where people can get upside down on a foreclosure. So don't forget, when that happens, there is a solution. It's outside the scope of this video to 1031 exchange. It's called a debt, DEBT exchange. People do them. It's possible. I can hook you up with some people that specialize in it. But that's calculating capital gains. And those last two problems kind of showing you that your cash that you receive has nothing to do with the taxes you're going to pay. That's the point of this whole video. I'm going to go back one more time, just remind everybody this is our formula. Thank you for having, oh, there we go. Sale price minus tax basis equals gain. So if you can get that straight, I'm going to go all the way to the last slide, make sure we get the disclaimers. Lastly, I got to mention this. I am an attorney. I'm not your attorney. An attorney-client relationship can only exist if we contract for it. You can read the rest of this. But you can't rely on this video as legal or tax advice, so don't try to do it. All right, this is Smarter About Taxes. This was calculating capital gain on investment in real estate. I hope you found this helpful and useful. Go to my website, Smarter About Taxes, if you're not already there.